What are capital gains? Welcome back, guys. In today's video, we're talking about capital gains and everything essential about it. Let's start with understanding what capital is. Capital is a broad term that can be described as anything that bestows value or provides benefit to its owner. For example, the financial assets of a business or an individual. In simple terms, capital means anything a business owns that contributes to building wealth. What are gains? An increase in the value of property or investment is gain. Another word for gain is to procure security. It means resources acquired or increased. What are capital gains? It is an economic concept defined as the profit earned on the sale of an asset that has now increased in value earlier over the holding period. It was at a lesser rate. What are the different types of capital gains? STCG stands for short-term capital gains. It basically refers to an asset held over 12 months or 1 financial years. At the same time, assets held with a company for more than 1 financial year are LTCG or long-term capital gains. For example, securities, bonds, equity or preference share, zero coupon bonds, etc. When the given examples are held for 12 months, then it's called short-term capital gains. And if they are held for more than 1 financial years, then it's referred to as long-term capital gains. If assets are acquired through gift or acquisitions or hostile takeover successions or inheritance, the period of which the previous owner held the asset will also be determined while asserting whether it's a long-term capital asset or a small-term capital asset. The next exceptions to capital assets: any stock in trade, consumable stores, or raw material held for business, archaeological collection, movable property, such as expensive furniture or clothes, except for jewelry, drawings, paintings, sculptures, etc. How to compute capital gains? First is the full value considerations, final sale price. It is a considerations that the seller receives in return for all his capital assets. Second comes the cost of acquisition. It is known as the value of an asset acquired by the seller. The third is the cost of improvement. This is defined as the expenses incurred by the seller in making additions or changes to the capital assets. Next comes the cost of transfer. The transfer cost incorporates the brokerage charges, registry charges, including all other expenses and changes made during the asset sale. Fifth is the index cost of acquisition. It is the thing that is evaluated by applying the CII, the cost inflation index, to settle the inflation values over the years when the capital asset was held. Also, this cost is known as the year's ratio, CII of the year only when the seller sells an asset either when the asset was attained or the FY 2001-2002. Finally, there is the index cost of improvement. It is the value that is calculated by multiplying the cost inflation index of the year with the necessary cost of improvement divided by the CII of the year when the improvement has taken place. So, this was all about today's video. Stay tuned and subscribe for more.